Hey fans, I hope you're all enjoying the program tonight.
You will be a weapon. You will be a minister of death, praying for war.
You're not inside, you are outside, okay?
Sir, I heard it was the best, sir.
It is the best.
The only problem you're gonna have is that you didn't buy more.
All right, everyone. Welcome back to another week. Kyle, how has your week been?
It's been pretty hectic. Had a, just like with kids and everything, it's kind of nonstop. We had our son dedicated on Sunday, but really great weather here in Texas. Kind of just day drank on my patio the entire Sunday, and it was really good. But this is a really busy week for work. I'm helping lead this huge conference at work, so it's in addition to my regular duties, I have this on top of it.
You actually do have a day job.
Yeah, that's it's testament to my shit posting talent that I can do that and remain productively employed.
You can do both.
Yeah.
When you started SITREPs, were you in the reserves?
No, I wasn't.
You did the reserves for how many years post active duty?
I did it 2 years during my MBA program, and then when it was time to go get a job, right, or go. I was going to go into consulting after my MBA. I was like, no, absolutely not. I am not going to be Monday through Thursday traveling and then go for a 3-day drill weekend. It just was not in the cards, did 2 years, and I'll be honest, going from active duty to the reserves is a shock for a lot of people, and it was a shock for me. It's just it's not active duty, right? So, but
yeah.
It is interesting to see. It's a good deal if you can make it work.
Yeah, for the variety of stories that I hear from people in reserves. I mean, people can go and watch the video we just did with Ed Kennewick about his time in the Navy Reserves. Very interesting stuff. But the variety of stories that you hear from people in the reserves, everything from I did 2 years of barbecues to I deployed, and the 3 soldiers that were just killed in Jordan were reservists, and you hear all sorts of stories. So yeah, anyone that's thinking of joining the reserves, definitely diligence your unit, right?
It's so tough, and I think it depends on your MOS, like how low density your MOS is, like how in demand it is, right? And it's tough to predict what's going to happen. I mean, there's a lot of critical specialties in the reserves, and that get deployed and get used, and then the reserves aren't the National Guard, but they do have I think it was a DSCA mission, as well. So I like a lot of things in the military, your experience may vary.
Yeah, your mileage may vary. Well, we'll jump in this week, and we want to talk about 4 main things. The first is Chinese cranes and why we should all be worried about the situation at our ports. The second thing we're going to be talking about is the insanity with Nvidia. So kind of breaking down, everyone's hearing about Nvidia, but what do they actually do, and why is their stock so high? And then we want to jump from that into talking about exactly how you can think about why stocks are priced the way they are. And then lastly, we'll tie up with a discussion from the weekly SITREP and talk about consultants, why you should or why you should not be a consultant, and the value that they may or may not add to the economy overall. So first, this Chinese cranes story. We've learned that the US, part of the infrastructure bill that was passed last year, that big kind of bipartisan bill, 20 billion of it has been assigned to help build large industrial cranes, largely for ports. And the concern is China. So from what you're reading, why should we be concerned about cranes made in China at our ports? What's the worry?
Well, I think like a lot of, pieces of technology today, or anything, you have like cars, trains, planes, cranes, right? They're all networked. They all have information systems in them. And so what this article brings up is that essentially, like, these cranes have been made in China, right? And like I said, like they're networked. They have information systems. They can like identify like the sort of cargo they're picking up, right? They can be remotely like updated. They can be like they can have diagnostics done on them remotely. And so the concern is that like back doors have been like built into these cranes that are all these major ports. And in the event of some sort of confrontation between China and the US, right? This would be like a lever the Chinese could pull to basically disrupt the ability of the US to, do commercial shipping, military movements, etc. Like, oh my gosh, like all the cranes at the ports have gone down, right? Or they're malfunctioning, or they're or almost even worse, right? Like they're working, but we think that they're able to transmit back to the
Yeah.
PRC exactly like troop movements and like material that's being like loaded and stuff. It's
Well, I
crazy.
thought it was crazy. You think about, I mean, I thought about in Anchorage when we went to JRTC, down in Louisiana, we put all of our vehicles on boats in the port of Anchorage, and we loaded all those, those boats went down through the Panama Canal and wound up in Mississippi,
Mhm.
and they offloaded them. Similar though, if like if we have boats that are headed over to Kuwait, or if Taiwan ever popped off and we had to send stuff, right? The thing that was the scariest was that China would be able to know exactly the cargo, right? They wouldn't have, they wouldn't even need to be shutting it down, but they could say, "Oh, look, like we know exactly the cargo that they're putting on these boats. We know the weights, we know the types of vehicles, we know where they're going, when they left, when they'll be there." And the next thing they could do is just shut it down. So the amount of knowledge that these cranes, that you don't even really think about it, but that these cranes are submitting over to the PCC or the CCP, excuse me, is pretty terrifying. And
Yeah.
I think kind of like, makes you wonder what else we have that's here in the US that we don't even think about that could be a huge strategic advantage for China.
Yeah. And just so the idea that like there's this huge effort to basically like replace all these cranes with homegrown cranes, right? It's crazy, right? And I mean, it's just crazy to think about. And it's like that level of like diligence being applied to like, hey, along every aspect of the US, like the vectors that somebody could attack the US, right? Like think about it, and it's just like, where are the vulnerabilities at?
Yeah, I mean,
It's wild.
you could shut down the U.S. economy if you wanted to, right? With even shutting down, we really have two ports that we're able to bring a lot of stuff into. The one is Long Beach, and I think the other is Houston. But our port capability is actually pretty poor in relative terms to other countries. That was something that I think COVID really demonstrated. There was that huge supply issue that we faced, and a big thing that it showed us is that our ports are not up to par. That we kind of are we have a long ways to go. So hopefully this kind of spurs some growth. The difficult thing is, I mean, there's a reason we have all these cranes from China, right? It's not because like China forces us to buy them. It's because it's really hard for American firms to make cranes. Like we don't have that domestic capacity, and that's why we have to invest 20 billion. But the worry is also like, we hope that with $20 billion of incentives that we can build these cranes, but like America doesn't build a lot of stuff anymore, right?
Yeah.
So
Yeah, I think there's this is like kind of a tangent, right? But way back in the day when the Matrix came out, like the final Matrix movie, they released like a series of like animated shorts for the Matrix, right?
yeah,
And like one of them like basically like talked about the rise of the machines in the Matrix, and it was or the rise of the machines that led to like this conflict between humanity and the machines, right? And like basically what happened is like these machines got like super good at producing really cheap goods for people to buy. So people were like driving like cars that were being produced by like, the machine race and everything, right? And then like they were like using like ways to like manipulate the market against humans, like just by like using humans' own like natural tendencies and like self-motivated like incentives to like, they want things that are better, cheaper, as like a lever to like use against them. And you almost kind of look at it like that, like comparing like the Chinese to like machines or whatever, but they're doing the same thing. It's like, hey, we'll make stuff that's really good, really cheap, and then put backdoors in it as a way to take advantage of the fact that America's economy is decentralized, right? And people are allowed to make individual purchase decisions. So
Yeah, I mean, you think about with Taiwan, right? We're kind of like anxiously watching. Xi clearly would love to take Taiwan if he can. That's a
yeah,
discussion we could dive into for another time about the complexities of Taiwan and why a large portion of the island of Taiwan would be, open at least to overtures from China. But like, man, if China wanted to like take Taiwan and they just said, hey, if you defend Taiwan, we'll just shut your ports down for the next year. Like, you don't have cranes, you don't have you don't have machines. We'll just shut your entire country down. And how quickly would political opinion right now, or public opinion right now, is very supportive of Taiwan, excuse me. But what would happen if everyone suddenly realized, not just like that your iPhone couldn't get there, but like your X-ray machines, your MRIs, your medical supplies, it's not just toys that come via ports. So it could be very difficult. So there was several interesting Chinese articles. There was another one about their surveillance state that basically said like 1.3% of people in China are surveillance assets for the state, and there's
yeah.
like 0%. There's like zero trust in that society because literally the chance is like 1 in 100 that the person you're talking to is an informant for the
Is it an
CCP.
Yeah, I'm a little older than Wyatt, right? And so I remember the Berlin Wall falling. I was very, very young.
Yeah.
But like
Yeah.
like when the Soviet Union was around, and they had like West and East Germany, and the part that the Soviet Union controlled, they had informants basically all throughout that part of Germany, right? And like the Stasi, the police that ran that area,
Yeah.
and they would basically like your neighbors would like snitch on you, right? And so it's like a way for like a totalitarian like dictatorship to basically control its people, is to sow distrust among the people who live there, right? So people are afraid to speak out, they're afraid to organize, they're afraid to have dissenting opinions.
Exactly.
And this is part of what China does, right?
Well, they don't just do it in China. They do it. A big portion is there's a massive reporting element among every Chinese student at a university that a lot of universities actually won't even put Chinese students together in classrooms because the Chinese students will never comment because they're terrified that the other one, if they say anything that could be construed as pro-American, pro-Taiwan, anything that the CCP doesn't want, that they'll report on them and that their family will be punished.
Yeah, so they find a way to like exert control, in other countries, right?
Exactly.
I think there's stuff that came out like a while, like I want to say it was like a year ago or something, but I can't put my finger on the exact time. But they were like, the government was like going around, and the U.S. government was like shutting down like secret Chinese like police stations in the U.S. or something.
Yeah, I remember that. There was one in San Francisco that got shut down.
Yeah, it's like, no, this is not okay.
Yeah,
It's not allowed to do this.
there was there's students at Wharton, man, that like that they're from China and like they'll never comment in class. And there was one last year. He was a second year student, so graduated now, that was in one of my strategy classes, and they were talking about there was a strategy class about China, or there was a class that was talking about Walmart's entry to China. And the teacher was like, "Hey, what do you think?" Chinese student, and the Chinese student kind of gave this like very party line answer, didn't really want to do follow-up answers, and the rest of the class never spoke. Mm-hmm. And one of the students was like, "Oh man, like, that kid, like, I wish I could have debated that kid. And I was like, dude, that kid might not have agreed with anything that he just said, but he can't say anything. Like he's completely hamstrung by his regime. So, oh man, it's very difficult to see, free market and free ideas grow in a society where no one can trust each other. And we need to make sure that we're being careful here in the U.S. So I hope we get those cranes built fast. It's going to take a while though.
Yeah.
So speaking of tech that we are able to build, or that we're hoping to build, Nvidia, they are the hottest company in the world, I think, right now. What do they even do?
They build GPUs, graphical processing units. So for those of you who are not in the know, graphical processing units are basically specialized computer chips, right, that allow for the computation of really complex math that allows for the display of like advanced graphics on anything, right? It could be like
Where did they started as a video game company, correct? Because the video game graphics are it involves a lot of matrix math, and it's
this is the point though, right? They make GPUs, right? And so
right.
They started as like they started as a they've been around for like 30 years, right? And they started making computer graphic cards, right? Like back in the day, right? I feel like I keep dating myself, but like when I was growing up, you'd have like, I remember going and getting like video graphic cards, right? And be like, oh, this is the Voodoo 7X, right? And I'm going to go put it in the PCI port of my computer, and it's going to like supercharge my gaming experience. And I'm going to be able to like play Mech Warrior or something like who knows, right? Like I forget even what it was, but it was like super cool and exciting, right? And like you'd go to like the video game store in the mall and get it. And so this company was building these, right? And like what they've realized in the past few years is that their GPUs are perfectly suited for AI, right?
Right.
Because
they realized it. Fascinatingly, they realized it largely because some medical uses were like, hey, can we use these video game chips? Like Nvidia didn't see the opportunity at first themselves. These medical companies said, hey, these can do incredibly complex functions. I think these would work for our medical operations. And then Jensen Huang, he's the CEO. He's been the CEO for 30 years. He was the founder and CEO. I mean, the man is going to be, he could be the most wealthy man in the world shortly. It wouldn't shock me if like in 5 years he was, but he's been the CEO for 30 years, which is pretty like, that's amazing.
Yeah, that is not the normal trend for Silicon Valley CEOs. So.
No. And, there's like a million different, there's like a million different profiles being written about this guy, but apparently he says like, he doesn't make strategy plans. Like he doesn't plan for the future. He just kind of like,
yeah, he has like a radical like decision-making or governance structure. And
yeah, he doesn't wear a watch because he says the most important time is now.
Yeah. So he's, it's interesting company that, what's interesting about Nvidia, right, is like the way the analogy you would use that I've heard that makes a lot of sense for folks who maybe are not totally familiar with it is, everybody wants to mine for gold right now, and gold is AI, right? And so Nvidia is selling the pickaxes for that. And
right.
You can't do it without their graphics cards, essentially.
Right. So yeah, to kind of finish the loop there, they were using these GPUs, for medical, for video games, and then they went and they started using them for AI, right? Because AI requires this incredibly complex large language model, a lot of the matrix math. So why are they so valuable right now? Why are they the company, and why not someone else? I mean, why is it so hard for other companies to come in and take their market share, right?
Yeah, I mean, like computer chip manufacture is extremely complicated, right? There's only a few companies in the world that can do it reliably and at scale and produce produce these sort of cards, computer chips that are specialized in nature, right? Like it's not, you look like Apple. Apple tried to like produce like its own computer chips. They basically tried to create their own vertically integrated supply chain. They weren't able to do it. It was too hard. Like think about Apple. It has unlimited money. It's the smartest people in the world.
I saw that Google and Amazon have started to make like complementary chips, but they've even emphasized like, hey, we're not competing. Like,
yeah, it's just too hard to do, and it's like a really specialized skill set, and it requires like enormous investments of like capital, and like design and like research, right? Like they're building these fabrication plants up here, north of Austin, and like Samsung's building them, right? And it's all like very like custom, and it's just like it's very like it's just not an easy thing to do, right? Like you're literally like building teaching rocks how to think, so
yeah, it's like we talked about earlier. It's not even with all the money in the world, right? Like it's not as easy as just being like, hey, go do this.
Yeah. And so, for Nvidia, right, they've come up like really specialized GPUs that are perfect for AI, and they don't have like really any competitors right now that can match them at scale, or their architecture, or the ability for them to be used in these sort of applications. But that doesn't mean people aren't, companies are not going to try, right, because they see the market opportunity. Nvidia can't keep up demand. Like Elon Musk said like a year ago that it was easier to get drugs than it was to get Nvidia GPUs, right? Because they're so in demand.
Well, their sales were really fascinating. They have the chips sell for about $25K, and most of their business came from they're not going to publish exactly who they're getting their sales from, right? That's kind of privileged information, but it's like 5 companies make up. I think it was like 60% of their sales. And you can kind of assume like AWS, right? That's going to be probably a main one. Probably Google, right? They're building Gemini. They probably have, OpenAI. Well, OpenAI wouldn't actually be. I'll correct that because I think they're using AWS, right? Or Azure. OpenAI would be using Azure, right?
Yeah, that's one reason why Microsoft. Basically, it was a huge investment, right, for them to be able to leverage Microsoft's cloud network,
right,
or cloud capabilities.
Right. So forget that I said OpenAI and AWS. Yeah. So OpenAI is on Azure, AWS, Google. These are all companies with big cloud computing sources, and the cloud computing allows them to, run these AI models. So OpenAI is, running their AI models on Azure. What's really amazing though is not just that they have these, this incredible market share that they have. I think it's like 80% of the market is controlled by Nvidia. They have a 76% operating margin or gross margin on a hardware company. Why is that? Like, explain for listeners why that's so unbelievable.
I mean, well, it's just they're selling these things at a huge markup, right? But like the input costs to make a computer, a GPU, right, are immense, right? There's a huge pipeline of like capital expenditures that have to occur, right? They got to like
right,
build the plants. They R&D is not part of CapEx, right? But like there's all these expenditures that go into it, and then be able to sell that sort of markup is like truly incredible, right? Especially for such a complicated and advanced thing. It just shows like the demand.
Yeah, and they can't fulfill their orders. I mean, Jensen Huang's like, I wish I could make twice as many chips.
Yeah. So it's just like a supply and demand issue, right? But like as Jeff Bezos has said, your margin is my opportunity, right? And so like in fact they have all this margin, right? So like AMD is going to come in, you're going to have
Saudis want to make some. Like the Saudis are like trying to petition. They've been giving like 5 times higher, like insane valuations to semiconductor startups to come, or at least let the Saudis invest, which is kind of insane. But and maybe that'll work. I don't know.
You have all these other entrants who are gonna like, there's money to be made, right? So they're gonna figure out how to do it. And like the growth, what I think is important for folks to maybe understand about all of this, right, is this isn't like a moment in time, right? This isn't like this is going to pass. Though, one could make the
Yeah, this
argument.
isn't a bubble. Like this isn't like GPU bubble, right?
Yeah, so like there's two ways to look at it. Semiconductor manufacturing, right? Chip manufacturing can be cyclical in the sense that companies will buy all of these, chips, all these semiconductors, right? And then they'll digest it for a period of time, right? They'll have like, they got to take it, they got to integrate it, they got to use it, they got to like build stuff on top of it. And then when they're ready to do the next thing, okay, like what's the next advanced chip that we can do to then like push the, envelope of like what we're building. So like there's a threat of that to like, Nvidia's business, right? But when you look at AI, right, like we're just at like the very beginning of it, right? Like the iPhone moment, but it's for AI now. And this isn't like a technology. It's not like crypto that's like a bubble. It's like something that's going to like rapidly change the world here in the next 10 years.
Yeah.
So, when you think about like a valuation, like stock valuations, they're the, present value of future free cash flows, right? It's investors saying like, hey, let's look at the future free cash flows in the future.
So explain what exactly is a future free cash flow is and different from just a revenue. So what are investors looking at?
Yeah, revenue minus all your expenses, right? And then depending on how you want to calculate it, right? You want to say like EBITDA or whatever, but
which as you look forward, the assumption with any business is that as you innovate, your cost will go down, right? So it's like if you have, or generally, right, if you have this process that's hardware, right, you're probably going to find better uses, better materials. You're probably going to find, there's probably going to be more people that enter the labor market. Your labor becomes cheaper, so your cash flows like will start to go down. And the worry, if you're Nvidia, is like you said, someone will come into the market and say, "We're going to make this cheaper and compete you down on price."
Yeah, so they'd say, so like folks would say, oh, they have a $2 trillion valuation, it's super rich, right? They have to like grow into the valuation, right? Because
I think it's 30x their revenue.
30x price to earnings, right? So like whatever your the current price of the stock is divided by their their earnings, right? So essentially like free cash flow, and so when it's like when the multiple is super high, right? Like basically saying like there is a lofty expectation that the company is going to be able to grow over the next few years into this valuation, and investors want to see that growth, so they have a high expectation for growth here. And so the argument is saying like, oh, like the stock is overvalued, but then people say, well, like, is it, right? Or is the AI boom going to be so great that it's actually cheap right now because they literally are going to have to grow this much,
Right.
And like,
they can't meet their demand.
Yep. So, it's just, valuations are like both an art and a science, right? So it's interesting to like see like this talk, right? And it's like, okay, they're a $2 trillion company now. They have a very lofty valuation, but like, if you really believe in the AI boom, and you really believe like, in the next 10 years, like there's going to be this massive increase in productivity, the economy is going to grow because, we'll unlock like, productivity bottlenecks, right? And there'll be an increasing demand for AI and the chips that power it, right? And you're saying like, well, actually it's kind of cheap right now because these guys are going to be in huge demand to produce all this hardware that's going to basically power the next great jump in technology.
Yeah,
so like I said, goes back to the pickaxe analogy.
Yeah, so I think it's interesting. We promised people we'd kind of walk them through some of the ways to understand this price, right? So Nvidia's stock price right now is $787, right? That's over the last 5 days, it's up 16%, right? Because their earnings came out and their earnings were higher.
They did very well in earnings, and the expectations were super high from analyst expectations.
So over the last 5 years, Nvidia has increased 1,900%, which is insane. In the last year, it's gone up 240%. The interesting thing I think about finance is when you're thinking about investing in a market, a lot of people want to day trade, right? Or they want to go and say like, hey, I think I know something about Nvidia. The reality of any kind of stock is now Nvidia, like the most amazing thing about it continuing to exceed expectations is now its growth has been priced in, right? So can you explain kind of like how does a Wall Street analyst, like when we look at the prices here, this reflects the public market price. How does an analyst go about, determining, hey, like what should we, what will the expectations be? So people always talk about, revenue expectations or Wall Street's expectations, right? It outperformed. What are people talking about when they're saying that?
Yeah, I mean, what they're thinking about, right, is there's a variety of different metrics they can use. So you could have like price, like we just talked about price to earning ratio, right? And so because it's kind of hard to compare like this stock, you could say like this stock is worth this much, and this stock, this stock is worth 1,000, and this stock is worth 1,000, right? $1,000 a share. Or you can say $100 a share, maybe like make it a little more real. But like there's a lot of things that go into that, right? You talk about like market cap, number of shares outstanding, et cetera. So it's tough to like compare like apples to apples, but like what you can use, at least, and somebody, an analyst would use, right, is they would look at like these different like models, right? So you could have like price to earnings ratio. There's like one, it's like, hey, like the price of the stock over the earnings of the company. You could have a price to book ratio, right? And so that's like a company's stock price by its book values, which is a measure of its total assets minus total liabilities, right? Just on its balance sheet. You could have the equity risk premium, right? So, it's like basically the reward for owning the stocks over risk-free government bonds. Well, it depends on depends on who you'd say if the government's bonds are risk-free. I say they're risk-free. Yeah,
The U.S. It's like my finance teacher here said, if the government bonds, if the U.S. government bonds have defaulted or they no longer worth anything, your stocks are useless by default.
Yeah, which is why people get so freaked out about the
it's kind of like shorting the possibility of a nuclear war. If you're right, you make money, and if you're wrong, you don't need money.
Yeah, exactly. The other one is like price to earnings growth ratio. It's called the PEG, right? And it's the market's valuation of a company relative to its earnings prospects, right? And so essentially, it's like divide a company's price over earnings ratio over the past 12 months by its projected annual future earnings growth. So basically, it's showing you like how like quickly is like this, like like is it growing? Is it growing at the right rate? Which is something people are really concerned with, right? Like when you look at stocks, like it's usually not enough. Oh, did it grow? Did it grow as quickly as we thought it was going to grow? That's usually like something analysts are very concerned about, right? Because if you see like decelerating growth or accelerating growth, it indicates like a trend. It's like, okay, like maybe the stock is slowing down, and because like stock valuations are tied to the expectations of future growth, right? It's like how quickly do you get there,
and where do those the expectations, like there's people that work on Wall Street, a lot of analysts that their entire job is to basically look at a company and assess like this is how much we think it will grow over the next year, right? And
that's why I say it's an art and a science, right? Because like somebody could look at Tesla, for example, right? Tesla's like a really famous example of a company with an insane P ratio, right? Like I don't know it off the top of my head, but if you can imagine, right, like based off like Tesla's P ratio and their valuation,
it's 46 today. So
and compared to what is like Ford's P ratio?
Ford's PE ratio,
right?
Ford's PE ratio is 7.7.
Yeah. So like they both make fucking cars, right? Like
it's right. It's a hardware company. It's a car company. Tesla is not a software company, right? It's a cool car company.
So like this is like what we're talking about, right? Like I don't know what Tesla's stock price is off the top of my head. I don't know what Ford's stock price is off the top of my head. But when you say Tesla has a P ratio of 46 and Ford has a P ratio of 7, right? That 46 is a much higher expectation of like future growth for the company, because the price is so much higher. The stock price is so much higher than the earnings of the company, right?
Yeah,
and that's like one way to say like, okay, like investors, analysts, the stock market has a really high expectation that this company is going to grow. And then they say it's going to grow like, oh, because for a variety of reasons, right? This is where the art and the science come in.
You can go read these market reports, right? I mean, JP Morgan puts out like expectations and market reports, and Nvidia's a 66, their price to earnings ratio. And like Apple, for reference, is 28. Meta is like 31. So I mean 66, right? It's like double what Meta is, and Meta is like growing a lot. I mean, the crazy thing to like think about with Nvidia is one of the reasons their stock is up so much. Like they were expected to grow. If you grow according to what Wall Street thinks you will do. So like if Nvidia would have grown their profits, 50%, which is insane, their stock price would have dropped. They 2.7x'd their revenue as a $20 billion company.
And it's never just enough when you look like the top line numbers and the bottom line numbers, like top line like revenue, bottom line profit, right? Like analysts will like delve into like, okay, like what elements of the company grew at like which speed, right? And it's like, like where are like the key growth areas, right? Because like certain areas of the company could be like more critical to growth in the future. And so they'll become very concerned about stuff like that. And it's like, is the growth in line with what we expect, et cetera? And if you ever listen to these like earnings calls, analysts will be like, hey, thanks for diving in. No, we just, we saw a little softness in the blah, blah, blah. And the, whatever sector or whatever segment of the company is CapEx doing X, Y, and, like that, like these are the sort of questions they'll ask,
right.
The CFO and the CEO, normally the CFO, right?
Right.
Or if it's like a growth area, they'll be like, COO or like whoever the fuck's in charge of it is who they'll be like addressing it to.
Right.
So, yeah.
So, I mean, the point being, you can go look at all these, Sonny, who, by the way, he's finishing his raise. He will be on next week. He already has a post that we were texting about today.
Oh, good.
So
good.
Sonny will be back next week. He's finishing his Series A raise. So congratulations to Actuate for that. That's like a big moment for a founder to actually, get to the Series A, because it means you have a good track record, right? Yeah. You have grown your revenue. But like Sonny was talking, he was like, man, if I 2.7x my revenue year over year, like investors will come give me money as a startup, right? Like making like 7 figures of revenue.
Yeah, because you show you have growth in the market.
Right.
And it's like, you can eventually become more efficient later and generate free cash flow, which is like the assumption, right? Maybe it's not so much the assumption anymore, but in VCs, investors, they just like to see growth, period. Right.
Right. They say like the triple, double, right? That's like the YC. It's like you should grow like post Series A, I think it's like, 300% or 3x, like first year, 3x second year, double fourth year, double fifth year. Nvidia almost tripled their growth as like a very mature company, and they were not fulfilling demand. So absolutely insane. Congratulations to any vets that like took an Nvidia full-time offer 10 years ago, because they're
I know. I mean, can you imagine? And it's just like some of this stuff is just luck, right? Some of it is just, like if
10 years ago there was probably some guy in an apartment right around me, someone that was like at Wharton, took some job at like a hardware company, right, making video game chips, that they were like, yeah, this is like a good job, right?
Yeah.
It's a good job into tech. They're giving me like 50K equity a year. Now they're probably worth like 20 million, 25 million. And they never.
I think I saw if you invested $1,000 in Nvidia 10 years ago, it'd be worth like 1.3 million today. So I want.
If you invested $1,000, no, I just found it. If you invested $1,000 in Nvidia 5 years ago, your investment would have increased by an eye-watering 1,015% and be worth around 17,000. If you had invested 1,000 in Nvidia 10 years ago, your investment would now be worth 150,000. So take that by a factor of 10, right? You invest $10,000.
Not like a crazy amount of money, right?
No, 10,000, like,
Yeah.
that's like you could have easily done that. I mean, my wife would like have yelled at me, but invest 10,000 in Nvidia 10 years ago, you'd have 1.5 million. And if you would invest 100,000, like you'd be 100,000, you'd have now $11 million. You could retire. Yeah, and there's probably some like MBA grads that like $10,000 is well below what you'd be getting for equity grants. So there's probably some MBA grad that took a like program manager job at Nvidia.
It just depends on how much risk you want to expose yourself to. Single variable risk, right?
So, congrats to whoever's listening. If you did take that role and you want to come on the pod and like talk about how much money you've made, please do. Because
still working,
while you're still working. I guess because you hope that your 25 million will grow into 50 million, I guess. Which it could. But the last one, the CAPE ratio. Did you talk about that one?
Yeah, the CAPE ratio, right? So this one's actually super important and one that you'll hear a lot of folks talk about. I don't think it's well understood. It is the cyclically adjusted price to earnings ratio, and it was derived by a guy named Robert Shiller, who's a Nobel Prize winning economist, right? And what it does is it's calculated by dividing a stock's current price with its average inflation adjusted earnings from the previous 10 years. And so what folks love to do, right, when it comes to finance, right, is they love to have like some sort of CAGR, like sort of like
compound annual growth rate, right?
Yeah,
over the last 10 years, how much have we grown?
Yeah, on
average.
On average, right? Because you have like with like growth rates, stocks, etc. You'll have like big dips, you'll have big gains, right? And so you need to find a way to basically like average that out over time,
right?
And see like what is the actual like growth rate over like a defined period of time. And this is essentially what the CAPE ratio is trying to do, right? And so the advantage for it is that it corrects for extreme good times and bad times, and it smooths out periods, where there's like, kind of like black swan type events, like say like a housing bust in 2008, or when there's like an unusually like strong, economy that makes like stocks like go up really high for some reason. Post-recession recoveries, where weak earnings make stocks look expensive. So that is, so it says it's typically this model is used to value cyclically sensitive companies such as banks and those in the mining and oil and gas industries because their outlooks are influenced by consumer supply and demand and economic growth, right? So that's another model that, an analyst would use to basically say, oh, okay, like how do we compare, company A to company B, like how's it doing, historically, how's it doing like relative to its past performance, et cetera.
Right.
So yeah, these are all like interesting ways to like, look deeper, right? Like the price to earnings one is always going to be the easiest one folks talk about. Like that's probably the closest.
It's the easiest to understand too, right?
Yeah.
You take the price, you divide by how much it earns, and
it's just like it's the closest to like the on the street metric that you're going to get.
To put it in the simplest terms, if like you think the company is going to be like out of business in a year, right? You're like, hey, whatever they earn today is the price, right? Because like they're not going to exist. If you think that they're going to continue to earn more and more and more, you're pricing in those future earnings. So people really think Nvidia is going to, I mean, you're basically saying I'm going to pay a lot of money for this stock because I think they're going to earn 65 times whatever they earned this year into the future. And that could be, people don't want to hold a stock for 65 years. So they clearly are saying it's going to grow, and it's going to become harder for the stock to grow. I mean, that's the thing is, when you start to bet, if you get into Nvidia now, maybe it continues to climb. It probably does, but
this is the argument. Like, are stocks actually cheap or are they expensive? Right. This is the argument everybody has. Right. Like when the stock market, because the stock market is like it's done very well, and people are like, okay, like are stocks too expensive now? Or do they have room to climb higher? Like this is always the argument folks have, right?
Right.
Your outlook.
And that's why, it's why it's very, very hard to create your own profile, because it's like the information mean, Sonny had a post on this on LinkedIn where he's just like, look, people that try to play the market, like you get lucky every once in a while, right? You buy
Like
in
it's like gambling. Like there's too much
gambling.
information, right? The market's,
You're
the
competing against some quant kid from Caltech that like
well,
understands.
well, not only that, you're competing against a market that has become much more efficient in
Yeah,
the last 20 years, right?
yeah,
With the advent of computers and now with AI, right? It's going to be like any information that comes out is instantly like priced into stock. In
right.
stocks, it's all priced in,
You're
right?
betting. Yeah,
There's no like arbitrage to be found.
right. Any
At least
person that's honest
yeah,
will say like I am gambling.
yeah, yeah, exactly, right. And yeah, exactly. Like, oh, you're going to take out a call option on some, on something betting that they're going to beat earnings or something, right? And if you don't have like insider information, which is illegal and something I would never do, like you would, you're essentially like it's the same thing as going to the casino, right? And being like, yeah, let's put it on 32 or 32 black, right? And let's see what the roulette wheel does.
Right.
Uh,
Right,
which
because anyone like the thing is like now Nvidia, right? All the analysts are going to say, look, Nvidia can grow like they're growing like crazy. They haven't met demand. Our expectations have risen, right? They better 2x their earnings in the next year. So if they 2x their earnings, it doesn't help the stock price, right?
yeah, yeah,
And
yeah.
maybe they will 3x the earnings, right? That's the bet that
Yeah,
anyone puts on.
whatever bet you're taking, right, with these companies where there's really high expectations of future growth, you really need to make sure you understand like what you're getting into, right? Because the stock is very expensive already. It's like the future growth expectations are super high, right? And so you don't want to, you don't want to buy in where it's like, okay, these guys have to crush it every single quarter for the next like 5 years in order for you to basically not lose money.
Exactly. So
You know.
you might as well go to the casino. I mean,
Or
maybe
just invest in the S&P. Just invest in the S&P.
right. That's the argument. Right? I mean, I had a class here about asset management. The professor just said, look, at the end of the class, it was kind of a dismay. It was very interesting to figure out like how stock prices, how the market calculates stock prices, how you understand what a company's worth, all these different metrics. But at the end of the class, he's just like, look, I'm teaching this class. I understand this at a granular level. I've tried to I actively play the stock market, and annualized over the last 20 years, I don't beat the S&P because there's just too much information out there.
I mean, I think I really highly encourage, especially veterans, take as many finance classes as you can take, just so you can just like the conversation we had, just so you can understand it, And at the end of the day, you'll probably come back to the same, conclusion we had, is that you can't beat the market, but at least you'll be more informed and you'll understand it. And you'll have shined a light in an area that's pretty important. And you'll understand like risk a little better. And I think you'll also understand like when you're evaluating like a job offer from a company, right? And they're going to pay you in stock. And be like, what is the level of risk I'm signing up here for?
Right. Yeah, you can analyze. I mean, that is something that I think it's important that you're saying is it's not just about understanding, if I'm going to go and start playing the market, because I think betting on the S&P is the best bet you can make. You will get job offers with equity, and you should evaluate that stock and be like, is this stock going to grow? Right.
Yeah, because you're now exposing yourself to non-diversified risk. Right? It's the variable is your company. It's as if you were buying, call options in that company.
Yeah.
So.
A lot of these jobs, I mean, we were just talking about an Amazon job. They offer about 150,000 base and 150,000 in equity per year, right? That's not like a one-time bonus. That means every year you're making, your total compensation is 300,000. 150,000 of that you don't get. Like that goes into an account. And if the Amazon stock grows when it vests, like you get the growth, but it only vests 5% year one. This is for Amazon post MBA. It vests 15% year two. That's pretty I mean, that's incredibly low, right? The incentive is like, do not leave Amazon.
Yeah, but like they pay you in cash.
Right. They do pay you cash, right? They do pay you cash. And
The vesting schedules is different.
is pushed forward. So you have to kind of look at that and be like, for Amazon, you're like, okay, I'm probably going to at least be able to say I'm making 150,000 and like it's in a savings account, right? And it might grow to like 175,000, right? Like we said with Nvidia, if you would have taken that Nvidia job 10 years ago, you're now worth 25 million. But if you think your company, like if you go to a company and you're like, man, this public company's stock's been dropping, like they made me this sweet offer of like, $200,000 in stock. Their stock has been dropping like a rock. That 200,000 by the time it vests might be 30,000. So it is something to consider when you're looking at these offers, right? That's not cash. So
yeah, so no, super interesting stuff for sure.
Yeah, so Nvidia is the hottest stock. Be careful if you go buy it, and hopefully people, if you're interested in this, there's a great Wall Street Journal article, and you can just go online and research, stock valuation methods.
There's just YouTube or something. But...
Yeah, there's a lot out there. Last piece to wrap up for those currently at their MBAs, like myself. Well, not me, because this is well past recruiting season for consulting, and I'm not going into consulting. But for those that are entering into an MBA, or maybe are contemplating their job offer into consulting, weighing it against other just-in-time opportunities, which for those of you who are not familiar with MBA recruiting, a lot of firms, both startups and mature companies, will recruit just in time, quote unquote, right? So 2 months out from the hiring date. And sometimes consultants will get cold feet and they'll say, man, do I really want to go be a consultant? Or maybe should I like go see if Google will hire me? And if I get a job at Google, maybe I go there instead of being a consultant. So Kyle, you had a guest this week on the Weekly SITREP that wrote a pretty big indictment of consultants. Why don't we start out? You were a consultant, so obviously it had some value to you. But what is the upside of consulting? I mean, why should someone consider being a consultant?
I'd say it's like 3 areas, right? The first is it's a very powerful brand. It's in the corporate community, it's kind of like revered as like, oh, you're a consultant, right? You've seen a variety of business problems. A lot of jobs, a lot of roles, like we'll frequently say in corporate roles, be like, hey, preferred prior consulting, strategy consulting, whatever, management consulting preferred. Because a lot of consultants leave consulting and then go into the corporate, and they have a well-equipped skill set of like PowerPoint, Excel, stakeholder needs, like they're smart, they can do analysis. So it's like one aspect. Second aspect is that in general, you get to see a lot of like different companies during your tenure as a consultant, right? So you get exposure to a lot of different like processes and like ways of doing business and thought ideas, right? And
you kind of push off the decision of what do I want to do, right? I think that's what
it's kind of like residency for MBAs.
Right. Yeah.
Then the third portion is that you can develop a great network, you can develop relationships with clients, right? They're good exit opportunities, right? So there's generally like if a consulting firm was going to sell you on coming to work there, those would be like the 3 things they would tell you, because they know like the turnover rate for their junior consultants are pretty high. And so like generally like a consulting company will hire, X number of MBAs, throw them against the wall and see who sticks and basically last.
And a lot of them, I mean, now it's a lot of people get pipped or get a performance improvement plan, which is basically like you're told go look for.
Well, I mean, all consulting firms have had like, they have like an attrition model where they're like, okay, X number of people are going to quit on their own. We're going to politely ask, X number of people to leave. etc. And yeah, it's increased lately because of just there's not as much demand. Every other industry they overhired. Now they're trying to correct.
So, what is the value add if a partner came to you at your place of employ and said, I want to sell McKinsey's book or Deloitte's book. what would their value prop be? You know, to a tech, you work at a tech company. Why would McKinsey come or Deloitte
Or
or
I mean,
EY, right?
for they, it depends on what like role you're in and like what you're trying to do, but they could say anything like, hey, if you're looking to like validate a new strategy, or if you're looking to explore a new strategy, or if you have some sort of problem that your current team can't handle, right, because your current team is soaking responsibilities, like we can come in and do the analysis and provide you like recommendations, and and then the next thing would be like, and then we could sell you an implementation plan to like execute those recommendations. Would be like like a typical like consulting like plan, right? It's like, hey, we'll come and do the analysis, then we'll help you like execute the analysis. Then the other thing they do is like, oh, if you're say going through like like I worked in like a deals group when I was a consultant, right? So we'd help companies go through a merger or spin off. They're looking to sell themselves, right? And so there could be, hey, you can come do due diligence on on an asset or business unit we're trying to sell, or and help us understand like what are the what are the like the costs that could be like minimized, right, or taken away, or what would like the future operating model look like, right? And we could like represent that in like a quality of earnings report, or a financial model when we were looking to like like, hey, if you're going to spin off this part of this company, right, like here's what it's like run rate costs would be.
There's a lot of one interesting thing. One of my friends that worked in private equity said that one reason that a lot of private equity funds will like to use consultants is because you can have what's called add backs when you sell, right? So you basically have consultants come in and do a bunch of work that an employee really should do, right? So if you buy this company, if another private equity fund buys the company, you might have to get some employees to do those work or those jobs. But because you had a consultant do it, you can basically say, look, those costs don't exist. We're going to add back those costs because they're not permanent, and that will actually increase the profitability of the company, hypothetically, because you've added back those.
Yeah, you have like you're just at EBITDA because you remove one-time costs, right? You see like recurring costs, right, are something you can predict in the future, right? But one-time costs are like, oh, we can add those back, right? So the EBITDA, the adjusted EBITDA, which is kind of like a
profitability, number, right? It's
like
higher.
It's like higher, and so it'll increase the multiple and therefore the sale, right? And it's also something consultants come and analyze too when they are doing due diligence on a.
Right, private equity will come and say, or to BCG has their pipe, Bain has their peg, their private equity group. They basically say, my friends in private equity are all very they always joke about consultants coming in and like making 100 client calls to assess client performance, while the private equity analysts do like the real work. Although I've talked to people that are now in private equity that are like, that's kind of that's a simple.
They all talk shit in each other. But yeah, right. So like there's a variety of like situations that consultants can come in, right? And so the article that my friend wrote, was basically just frustrated, saying that like consultants come in, they're trying to sell work, they don't fully understand. They're trying to solve problems they don't fully understand, because like some of these problems can be very deep, they can be very complex, operationally complex, right? And like some slick partner will come in and say like, oh, hey, like we can solve these problems for you. And what they eventually do is they do like surface level recommendations without understanding the extent and nature of the problem, right? And then executives.
How does consulting make money, right? I mean, at the end of the day, you have to look at the incentive structure of anything.
Yeah, it's like we need to continually solve problems, right? So, so yeah, I mean, he was just very frustrated because he felt like they've come in and like ex-consultants will end up in leadership positions where they may be like in over their head, and their natural inclination is like, well, we should hire some consultants to analyze this, right? And it's just this like never-ending cycle of fuckery where people are trying to like recommendations to recommendations, right?
Right, because if you look at the incentives, they just don't align, right? That's kind of what the cynic would say is like, look, we have these incentives. The incentive is to sell work. If you're client services, your incentive is to just create more work because that's the only way you get paid. There's no, as far as I know, there's no consulting contracts that include
like success fees.
Success fees, right? It's like you sell work, and so the incentive is to create more work, not to find success.
Well,
So,
I would say depending on the project, right? Some consulting,
yes, that's
some
a very
companies,
cynical view. Yeah.
some companies that hire consultants, right? I mean, in my my role was like in like the deal space, right? They view them as basically an insurance policy to make sure like whatever is going on is correct, because like say you work in like the deals group of a consulting company, right, or consulting firm, you have a lot of exposure to like these large strategic events. You've seen a lot of different permutations of like problems, right? Whereas that the company that's going through this strategic event is, the executives only see it like a few times in their career, right? So like bringing experts, right, to who have seen this a lot, right? And the experts are generally the partners or the associate partners, directors, etc. And then they have their junior staff execute on the day to day, and they supervise them. So
Yeah.
so it just depends, right? I don't know. I've been on projects where like literally the client was like, "Thank you so much for doing this. It was amazing. We don't know how we would have done this without you." And I've been on projects where like the client literally wants to fucking kill you because they hate you. Somehow partner sold the work to some C-suite executive, right? And their underlings like don't agree with it, and that's like a dynamic that you face as a consultant, and it's also a dynamic you face out in the corporate world as a just working a day-to-day job where you're dealing with hey, this initiative and people may not agree with it, whatever, or you're trying to get something done, people don't agree with it. So it's that's why the skill set is valuable, even if it is a little nebulous.
I mean, a lot of businesses, yes, like you said, consultants will do really good work, and consultants work their asses off. I mean, my friend just left BCG. He was only there for like 12 months. And as part of this, like, they raised the bar, which really just meant, layoffs, but they don't want to say layoffs. That said, BCG treated him well on the way out, right? They really want to make sure you get placed well because that's their brand. So he had no animosity towards them as he left. And in fact, he was kind of thankful because he said, look, like I worked from like 8 to like 10 every night. And I worked. He's like, it wasn't like I sat in the 3 shop and like kind of, shot the shit with guys and like talk to people and like would go and sit at Taco Bell. Right. He's like, I would like be deep into, expert interviews, analyzing data, like running SQL queries for clients and like working. He's like, it was work for like 5 days straight. He's like, 60-hour weeks are no joke. And he's now working at a tech company, working like 40 hours a week. And he really likes his life, but it's hard work. And he's, there's a lot of companies, like you said, where consultants can add a lot of value, but there's also, especially right now, I think there's a lot less work because a lot of these companies are tightening their belts, and that yields a lot of, what you're
third party spend is something that gets cut quickly in a tight environment. So
right. So partners will sell what they can because they need to make money, and you can't blame them for that. So
yep.
Yeah, don't want to discourage anyone, from considering consulting as a career, but if you know what you want to do, I think that there's definitely a case for doing that, right? If you want to be in healthcare, like go look at LDPs. If you want to be in tech, like, try hard to get into a tech role. If you go to consulting, you very well may do 2 years worth of industrial projects and be very hard pressed to find a job in tech or healthcare. So, consider that before you do take a job there.
Yep, for sure.
So, all right, Kyle, anything else you want to announce before we sign off today?
Nope. I don't got anything.
So, yeah. Anyway, everyone look out for continuing YouTube video series. We have some good interviews with people that have done prep for consulting and for banking that are vets that have just recently gotten out. So we'll have some prep series if you're interested in exactly how to prep for these careers. Other than that, we'll talk to you next week.
Cool. All right. Later, everybody.
And I'm not talking about some $400,000 a year working Wall Street stiff, flying first class and being comfortable. I'm talking about liquid. Rich enough, have your own jet. Rich enough not to waste time.